Hello, and welcome to Read the Bull, the only podcast dedicated to finance and investing books. I'm your host, Stefan, and today I am thrilled to welcome Scott Fearon. Scott is a founder and president of the hedge fund Crown Capital Management, and he's also the author of Dead Companies Walking: How a Hedge Fund Manager Finds Value in Unexpected Places. The book chronicles his 33 years of experience in the investing management industry. Scott holds a BA from Stanford University and an MBA from the Kellogg School of Management at Northwestern University. Welcome, Scott.
Thank you, Stefan.
So, not full disclosure, Scott and I have known each other a long time. I actually did PR on his book. The book was published back in 2015. So, Scott, we're coming up on the 10-year anniversary, if you could believe that.
Yes.
So, it was published in 2015 by Palgrave Macmillan. Had a great time doing the PR in the book. You know, on this podcast, we discuss books that are new. We also just discuss books that have stood the test of time. And I really, it doesn't matter that I worked on the book. Even if I didn't, this is one of the books that has stood the test of time. I like to dive into finance and investing books that either tell a great story and you learn something about finance and have some useful insights for people about how the industry works. And Scott, I think your book is that rare book that has a great story and is also useful for investors and CEOs. And really, since I've launched this podcast, I've been wanting to talk to you. So thank you for doing this. Now, you're based in Marin County, but where are you today?
I'm in Portland, Oregon. Yesterday, I just visited. I'm still doing this, visiting, 80 to 100 companies a year. I spent earlier this week visiting 7 companies in wonderful Seattle. So Alaska Air, Nordstrom. I was at Starbucks corporate office just yesterday afternoon.
Okay.
And a couple of smaller companies you probably have never heard of, Remitly, Radiant Logistics, Microvision. I'm still running screens and visiting a lot of companies.
Okay, that's great, because Starbucks is again, you talk about it because it was one of the companies way back that you had a chance to invest in on the long side. And I should say you run a long-short hedge fund. This book looks a lot about dead companies walking that failed. But that's not how you make money. You're a long investor too, and you go out and visit companies. So when you wrote this book, at the time, you had visited 1,400 companies. Is that right?
Yep, we're well north of 2,000 now.
I guess for our viewers and listeners, a long-short hedge fund manager. Scott, I'll let you explain what you do.
We manage $180 million, and we own 40 to 50 stocks, and we're short 70 to 100 stocks at all times. Okay. And I like to my stocks are mid-caps and smaller, and the simple belief that if there are pricing inefficiencies to be exploited by thorough research, on-the-ground research, they're going to be middle-sized, never S&P 500 names. So Yesterday was a weird day going to Starbucks because that's overanalyzed with 40 analysts on Wall Street. But that's what we do. So we grind. I do not take new investors. I stopped taking new investors years ago. Right. 180 million in assets. Why keep it small? So that I can invest in smaller companies. There are liquidity issues, especially as it relates to shorting companies that have a market cap of 200, 300 million. I couldn't run a $500 million or $1 billion. Immediate family is about 30% of the assets now. So you can map that out and conclude you don't need more money under management. It's still fun.
Yeah. I like that you asked a question that I didn't ask, but I was going to. It was why keep it small?
I put it in the book. I have to say this. There's a famous fund manager named Cliff Arness who I saw speak, but I've never actually shaken his hand. And he said, most hedge fund managers charge too much. They hedge too little. Yeah. I would add, and they manage too much money. You can make a lot of money with a 20% of the gain each year plus 1% of the management, which is a management fee. You don't have to run $1 billion or $2 billion. And in fact, as you get bigger, you're precluded from investing in smaller companies where there's arguably more pricing inefficiency. So I would add to Cliff Arness's hedge fund managers charge too much. They do. They hedge too little, partly because many are too large in assets. And thirdly, they do manage too much money.
Yeah.
And for every good reason, I've always felt the higher quality people keep their assets at a quote manageable size. I have very low respect for these guys that run $1 billion or $2 billion or $3 billion. And I probably have even less respect for the pension and endowment honchos that cheer them on as they grow and grow and grow. You know, these people are duplicitous. They're not really looking out for their funds return as much as they're trying to justify their existence. So simply because they're limiting their potential to maximize their return by growing their assets.
Right. Well, it's a great point. And you do discuss this in the book that, you know, when you get to like Starbucks or all these big companies, there's so much research, there's so much out there, so much information, like the prices are pretty efficient.
Yep.
You're focused on companies, you mentioned a few at the top that you've been visiting, that really maybe don't have the attention, aren't in the press. So maybe there's a little dislocation in terms of their price and what people understand about what they do. So that's why you got and visit them.
I think that applies more on the short side than on the long side, in the sense that our short strategy then a decade ago when we were running around New York together and now is I'm trying to find companies that will fail and the stock price will go well below $1 a share.
Yeah. Yeah. Okay. So you have such great stories, and I do want to touch on the book a little bit. You started your career, and this was kind of a formative time. You came out of college. I'm going to age you here. You came out of college, what, in 83, was it?
Yeah.
So you worked for an investment, the biggest bank in Texas, Commerce Bank, right?
Yep. We had a huge amount of money in our trust department. And so we had 5 analysts, and I pretty quickly started managing literally 150 million. Hey,
right.
40 years later, I'm still managing $180 million.
But it was a formative time, because what was happening in Texas at that time?
Well, Texas unraveled in the 80s, and I'm so old, I think very few people remember the price of oil dropped from 40, 50 to below 10, and companies failed, and especially not only did the companies, energy stocks and their go bankrupt, but we also had a debacle in real estate across the state of Texas, which was then more energy dependent than it is now. Yeah. And, I learned a couple of things, which is one, commodity businesses are a terrible business to be in. If you're trying to start a new company, whatever you're doing. Right. And secondly, lending money is one of the dumbest company ideas, because it's such commodity. So ever since then, I've never owned a bank stock. Wow. My entire life. I just think it's foolhardy. But that's what happened. I mean, it's not exaggeration. Unemployment in the Metro Houston area, I'm sure, went double digit from almost 2%. And so, it's kind of an eye opener when you're a young kid to see people all around you getting fired, and you yourself are going to get fired. And that was a long time ago, but it was an education. That was certainly, I learned more from that than I did getting my MBA.
Okay. And that's where you started to get out and meet with companies, right?
Yep. Yeah. On the theory that, it's one thing to read about a company, but you really need to go meet the decision makers to get a grip around, do they understand who their customers are? Do they understand who their competitors are?
Yeah.
What is their attitude towards capital allocation? If they make money, will they pay dividends, or maybe do share buybacks, or maybe reinvest in their business? Just where are they going with the cash flow of the business? And then lastly, I try to get my arms around Wall Street coverage of the companies. And that's where I learned that you just can't. You just can't substitute company meetings for a lot of reading. You got to do both, I would argue.
Yeah. So from there you went to GT Capital.
I followed my boss at the time back to the Bay Area, where I'd gone to college, undergrad, and I ran a mutual fund only for slightly less than 4 years. Did quite well, and the encouragement of a couple of hedge funds who are both long retired and both investors in my fund 33 years later. Wow. Started a little fund, and at my peak again, I've never marketed. Goldman Sachs is my prime broker. I refuse to go to Capri conferences. I've never managed one penny of pension or endowment money. And that's how these $1 billion funds become $1 billion funds.
Sure.
We're getting giant investments from the CalPERS, the CalSTRS, the Texas Teachers, the retirement funds, State of Illinois, and so I just managed money for a lot of wealthy individuals then and now, and it's still a lot of fun. Compounded after all fees at slightly north of 11% a year. Still doing it. So
yeah, you launched in 1990. I mean, there's so many ways you're just such a contrarian in terms of how you think, but also how you run the fund. And I don't know a lot of hedge fund managers that have been around since 1990. So that's that's a testament to you and how you run the business. But,
well, it's because I love doing it. Other guys do it for the wrong reasons. They do it because they want to get rich.
Right. And that's why they grow the assets.
They want to build a quote, organization. I once had a now long retired hedge fund manager who said, beware of the money manager who talks about building a business.
Yeah.
At the end of the day, you want to invest with guys or gals who, have a small support staff and they're so excited about their investment ideas, they couldn't give a rip about building a business. I almost literally both laughed and cried when I saw that Bill Ackman's going to bring his hedge fund public.
Yeah.
I think the movie about shorting Herbalife is one of the greatest movies I've ever seen about this business, betting on what's called betting on zero.
Yep.
But I just think it's tragic. Bringing a hedge fund public is bad enough. These guys raise money in Europe. Why? I don't know, because I guess running to 800 million is not enough for Bill Ackman. I guess he's got to run 8 billion.
Right.
But I don't have a lot of respect for guys like that.
All right. Well, yeah, you do comment in the book. You point out some things about the industry. Before we move on, your time at the mutual fund showed you some things of what was wrong with the mutual fund industry too.
Yeah, all they want to do is grow assets.
Right.
That's how they're paid. That was bad enough. But the way they would do it, with, giving trips to Hawaii and pens to brokers who jam their clients into the fund. And the mutual fund industry is truly it's in decline. It'll never come back, in my opinion. The vast majority of mutual funds, probably 99% have underperformed their respective indexes if you look over any great period of time. And part of the problem is they're all marketing companies, as Mr. Bogle said. Are they, salesmanship at those firms is definitely overridden the notion of being a steward of the client's money.
So I want to get into this because, you wrote this book and I want to ask, because you came up with 6 mistakes you look for.
Yep.
And let me list them and then I'm going to ask. Yeah. So you look for in each and I want to ask how you came up with these categories. Because you say first, recent past historical myopia, relying too heavily on a formula, misreading or alienating customers, falling victim to mania, failing to adapt to tectonic shifts, and then physically and emotionally being removed. So was this just after time you realized, looking back, these were categories that companies fell into? And I know some may fall into multiple categories, but how'd you come up with this list?
And that was a decade ago. So the fund was 23 years old then now. And the reason I wrote the book is I was lecturing at Berkeley and the professor said, these stories are great. You should write a book. And of course he had a journalism fellow who needed work. So, and who to this day works for me. How crazy is that? For me to this very day.
Yeah. Jesse Powell, who's credited on the book.
Great guy. Yeah. He does all my computer screening. We meet once a quarter. Anyway, I looked at all the companies we've been short that had gone bankrupt. And at the time, it was about 200 plus. Today, it's almost 280. We short stocks that are usually at a 52-week low with serious problems on the balance sheet. So I look back at all these companies that had failed, and it hit me that they all kind of made the same strategic mistakes. The first one's the most classic one of all. People look at the recent past and assume, like home prices are, people thought up until the debacle of '08, that home prices, if they ever drop 10%, you want to buy them because they've never dropped 12 or 15. Well, actually, there are periods in American history where home prices lost half their value. But you have to go way back to the Great Depression and the other ones as well. Manias. We know it's a mania after the fact. People love to be captivated by something sexy. And, I remember digital learning 15 years ago. Of course, today, the biggest question of all is artificial intelligence. It's not a mania. It's certainly going to transform society. But make no mistake, there will be a handful of winners and a lot larger number of losers. And because everybody says, oh, we're going to be AI. Well, that's not how the company began. So these 6 characteristics all applied to one or more of the companies that I had been short that had gone bankrupt.
Okay.
And they all made one of the 6 mistakes. Some made multiple. I mean, removed from your, absentee CEOs and CFOs, I've never seen it work.
Okay, so let's talk to us about some of these that you mentioned in the book. So this is a famous one. You're talking here about J.C. Penney.
Yep.
And
Ron Johnson.
Ron Johnson. We were talking about Bill Ackman, so
Ackman was on the board. Was Ron Johnson at Stanford? I don't care. I'm not big on alumni garbage, but this is interesting that you mentioned this. So literally just yesterday morning, I was in the office of the chief financial officer of Nordstrom, and she's super smart, and she worked at Target up in Minneapolis for a while. And I said, hey, did you run across Ron Johnson at Target? From Target up in Minneapolis, he became famous for running Apple's retail stores. And then, of course, he famously the board convinced him to run JCPenney's, and that was a disaster. And he was fired in about a year and a half. And the current chief financial officer of Nordstrom yesterday morning in her office in downtown Seattle said to me, Ron Johnson, you mean the guy that fired all of his customers and didn't even move to Dallas to work in the corporate office? I'm like, that's the same one. So, it's, you bring in a CEO who's a savant, and if he's not even willing to move to the city and work in the offices where the bulk of the employees are, you're never going to change the culture. And, his tenure was short. He was only at Penny's like 2 years. He made some really bad decisions. But worst of all is he didn't even live there.
Right.
So you've got to be all in when you decide to be the CEO of a company. And that part of being all in is you're willing to work and live in the city where the company's headquartered.
Right. Another one, I think, was the building materials holding company.
Yeah, that guy worked out of the tallest building. I don't know how well you know San Francisco, but the Maritime, not the Maritime Plaza. He was in the across the street. I can't believe I'm drawing a blank. He had a penthouse view of the water. And wait a minute, you're running a building materials corp, which is warehouses that sell lumber and building materials. His office should overlook one of the lumber yards. He should be in the middle of a lumber yard. He should be bumping into guys in the morning and the evening who are actually hauling the lumber and taking it to the customer site. Right. You can't run a company like that being on the 57th floor of a high-rise in New York or San Francisco. I mean, you can, but your odds of being successful drop significantly.
Right. So here's another category. And again, this is a name people are going to know well. Failing to adapt to tectonic shifts, the famous one is Blockbuster, I guess. And then back in the day, they were still around. But I don't know if people remember that they had an opportunity to really pivot, and they didn't.
Well, they came close. Yeah. Blockbuster, I was short and went bankrupt. Blockbuster was based in Dallas. They had, because I haven't reread my book in about 40 years. At the peak, they had, 4,000, 5,000. They had more than that. A lot of stores. Yeah. And Netflix was just starting in San Jose, California. And I went to visit Netflix in its early days, just like I went to Blockbuster 3 or 4 times. Okay. And Blockbuster literally had an idea, which was you could order the DVD disc online and then drop it off at the store, or pick the disc up at the store if that's after ordering it online. I don't even think I put this in the book. At one point, Blockbuster was an inch away from buying Netflix, but they decided not to because they thought that it was a flash in the pan idea.
So talk about what their strategy, what they decided to do.
Instead of just renting videos, because it became pretty obvious that you could either, a DVD disc in the mail, and then also digital downloading of movies was coming online, was happening. Right. And they were like, well, let's start selling junk in our stores, like popcorn and jujubes. And it was just nuts. I'm like, the world is rapidly transforming itself, and you're going to, offset your revenue decline from renting videos with selling gigas that you would get at a Cineplex. It was just stupid. What they had to do, I don't know if I could have done it, but they should have closed all their bricks and mortar immediately. Yeah. Go straight head to head with Netflix.
Right.
That's so easy for me to sit here.
Sure. They had so many stores at the time, and you get entrenched. It's easy for an outsider, but still.
Right now, as we talk, the cable industry is going away. Mike, there's nobody under the age of 40 who will ever pay a cable bill in his or her life, right? If you're one of these cable companies, you're facing this really difficult decision. Do we just shut down our cable operations and try to be all about selling, applying internet? Do we try to have our own streaming service? I mean, there's so many things that the cable world's trying to deal with, but instead they're doing what I think is the dumbest thing of all, is they're raising price on the few idiots who still have cable into their home. And I am one of them.
Me too, Scott. But we're over 40, so I guess that's the issue.
That industry is radically transforming itself, and it's difficult. Change is very difficult, but you have to. And in Silicon Valley, they quote unquote like to consume their cash cows. They'll put their own cash cows out of business if that's what it takes. Yeah.
Another example you had was the Yellow Pages, which surprisingly still in the early 2000s was a business, a public company, and existed. Well, and they thought, tell me what happened there.
Right, the Yellow Pages. So I physically went to meet with management, the CEO of a company called IdeaArc, and then they changed their name to protect the innocent. They were a Yellow Pages company, one of the two. And it's one thing to be the Yellow Pages, but they had a lot of debt on their balance sheet. And I remember saying to the then CEO in his office, I'm like, what's going to happen in the next 5 to 10 years? He goes, there'll always be people in America who use the Yellow Pages. You're not going to get a 40 or 50-year-old to start looking things up on his phone. I'm like, well, I said, one, they will. And two, I'd rather cater to 20-year-olds than 50-year-olds, because 50-year-olds are on the verge of dying, right? I mean, and 20-year-olds are going to be around for 40 years. So you're catering to a customer segment that's on its way out. I mean, truly on its way out.
Yeah.
But I've thought about that in the last 2 to 3 years. The core mistake at the Yellow Pages, and there were 3 or 4 publicly traded Yellow Pages, they all went to zero, by the way. They went bankrupt, went to zero, is that they had too much debt on their balance sheet. And so today I see a similar problem with a famous industry that only has 2 public companies. And that's the 2 companies that own movie theaters. The world is changing. Will there always be movie theaters? This is a fun discussion to have with a bottle of wine. There might be art theaters. There are some people who want to go to the Metroplex in Kansas City, but there's also a chunk of the population that's going to prefer to have that movie straight on their TV screen at home for any price. You probably would rather pay $20 to sit at home with a cheeseburger or a prime steak and watch a new movie than to schlep to the theater and sit in somebody's seat that's coated with greasy popcorn, right? So Cinemark in Dallas and AMC, which is super controversial and noisy in Kansas City.
Well, that's a meme stock too.
That's a meme stock. But those 2 companies, I think they're going to have to radically pivot. Part of the problem with both is their balance sheets are terrible. They have too much debt. I suspect both will end up at zero. AMC's raised so much money because every time the meme stocks spot that guy, he's at least smart enough to know I got to sell all the stock I can, raise as much money as I can because I have so much debt. The Cinemark's guys also have a lot of debt. But again, I'm getting back to a huge epic change in society, and not going to the movie theater, watching a first release movie at home. That is an epic change. But I think the trend is inevitable. And it's not like people are going to wake up 5 years from now and go, I don't want to watch the newest Mission Impossible here in the comfort of my home. I want to go to the Cineplex parking lot on a humid day and park, 8 rows back and schlep through the theater line. No, but that's a diminishing percent of the population that's going to be willing to do that.
Yeah.
So both stocks, I think, are shorts headed to zero. It's just a question of, are they both going to become meme stocks again? I'm shocked that AMC started running a month ago. I mean, I think people playing that game know full well long-term stocks is zero.
Yeah. So I want to talk to some others because there's so many good stories. This is a name that probably nobody knows. This is under the category fell victim to mania. There was this company, Quokka Sports.
Quokka Sports.
So tell me about Quokka Sports.
Remember when, the America's Cup became all the rage about a decade ago or 15 years? And so people, all the richy
rich. Sailing. Yeah.
Yeah, the people who live in Newport and Menlo Park and live in San Francisco and live in, the Upper East Side. Like, oh, I grew up sailing. Nobody in America gets on a sailboat. Nobody in America is a sailboat racer, okay? I remember that one of the Koch brothers was a sailboat racer and an alcoholic, and then he died from alcoholism. He won the America's Cup right around that time period, neither here or there. But anyway, there was a company in San Francisco headquartered called Quokka. They came public. I went to the office, met with the chief executive officer in his office, I think on Townsend Street in San Francisco. And I'm like, walk me through this. He goes, people watching sailboat racing on their digital, their device, on their laptop or their phone. That's the future, Scott. I'm like, no, it's not. Nobody gives a crap about yacht racing except maybe Larry Ellison, and he's a weirdo. And I said, this is not a business. And he's like, oh, no, look how exciting yacht racing is. I'm like, no, it's not. And the only people who do that are this slim slice of the upper crust in our country who also might be disproportionately involved in the money management and Wall Street game. And so, of course, the Wall Street crowd for a while thought it was a great idea.
Right.
Anyways, I shorted the stock at 5. It went bankrupt. I mean, it's the zero. And there's another one. Now you're getting me excited. A little more mass market appeal. Remember inline skating?
Yeah. This was First Team Sports, right?
Yeah.
Yeah.
I literally had people telling me, people are going to stop riding road bikes and jogging every weekend all over America. You'll see everybody on their inline skates. I'm like, no, that's not going to happen. That's just not going to happen. At the moment, it was popular, but I'm like, no. Right. There was a Minneapolis company that sold inline skates, and it didn't go broke, but they sold out at like $1 a share 3 years later when the inline skating craze became a bust. Right.
And then there was also you said biotech's also.
Biotech's hard, but what about it?
There was a company, Cygnus?
Cygnus Therapeutics. Well, now that one was, there's still hope there. They were going to have a watch that could read your glucose level, and certainly there's a need for that in our society, and rumors are always flying that Apple's going to incorporate that in their next iWatch iteration. That's an idea that is a good idea. It was way ahead of its time. The watch didn't work.
Right. You tell a funny story about how you went in there.
I was shaking the watch around and accidentally hit my arm against the desk, and the thing cracked. And it's like, and he goes, well, we've got a lot of, beta samples. That's okay. I'm thinking, that's awkward. And, the stock went to zero. Yeah. Bankrupt.
But you were rooting for them. I should say that you note this in the book. A lot of these CEOs, these aren't dumb people.
No.
These are smart people, but for one reason or another, they're just tied into a certain narrative, or they're just tied into they've surrounded themselves with people who are, telling them this is going to work. They're just something that, again, fitting into this category where they're just not seeing what's actually happening in their company.
Yeah, and their own lives is one of living in the upper crust of America, and the upper crust of America has different hobbies and habits that doesn't translate to all of America. Currently, this is my favorite, a stock I'm short today called Virgin Galactic. Okay.
Oh, this is Branson's?
Well, his name's on it. He's a flighty guy. I don't know the exact detail of his financial involvement. He does have an ownership stake, but I bring it up only for one reason. It might be the dumbest thing I've ever seen in my entire adult life. I mean, this notion that there's going to be a lot of Americans who will willingly plop down $400,000. Now the ticket's $650,000 to fly.
Thanks inflation.
Back. So I shorted the stock at 11. It's 80 cents. They're going to go bankrupt. But it's not that I'm right. I'm wrong a lot. It's just that how many people in America have the financial wherewithal or the intellectual interest to get on a spaceship for 2 hours?
Right.
And it's not high. And how Wall Street always says, the total area market, the TAM is blah. And I think the TAM for space tourism is almost zero, honestly. Yeah. Yeah. And worst of all for them, when you do it once, you don't do it again. It's not like eating a Big Mac. When you eat a Big Mac, you think, or better yet, Five Guys, which is my favorite upscale burger. When you eat at Five Guys, you're like, God, that's good. And like a week later, hey, let's go back to Five Guys. Nobody says, hey, let's go back to Blue Origin or Virgin Atlantic and fly to the edge of the atmosphere and back. Right. So these things were destined to go to zero the second they got on the screen.
Yeah.
And yet, again, that's a mania. Yeah. An unsustainable one.
Yeah. And another category, some good ones here, where they misread or alienate customers.
Right.
And then you talk about this company, which you liked a lot. It was one you visited and you had, I think, an affinity for from your childhood, Cost Plus Worldwide.
Yeah. Yeah, they tried to go upscale. They were a deep discounter of imported goods, predominantly from Asia. They started in the San Francisco Bay Area. Their corporate headquarters are over in Oakland, right underneath the 880, which is still there near the Broadway. And new management came in, and instead of trying to find really fascinating imported this and that, they started going upscale. Yeah. A lot of retailers, and today a lot of digital retailers do that. And they lose sight of the fact that people love a bargain and don't try to, take what was a treasure hunt experience and turn it into something where they can't find anything that's affordable.
Yeah. And
that's what Cost Plus did. They almost went broke. But then they were able to, they did somewhat turn it around. And it was them. It's crazy. Now Stefan, you're making me think about it. I think at the end of the day, Cost Plus World Markets, and there's some that are still open. It was bought by Bed Bath & Beyond, wasn't it?
Yes, you do say that in the book. And it was one of these where it was new management, I think, that came in. You detail that they lost their way. Yep. So there are companies that can get back on track, and we'll talk about some others. But you noted that they had gotten back to their knitting after a while, and then eventually, they were. I think you shorted them, and then wrote it back up. You sold it, you covered, and got
it. This was a decade ago, and now I'm trying to think of a current example of that. I can't off the top of my head, but these are strategic mistakes. People, money management is not a game of relative valuation. In my mind, it's a game of predicting the future.
Yeah.
And, these notion of paired trades and arbitraging and all this garbage, I don't do any of that.
Yeah.
I'm trying to predict the future.
Again, that's why I love this book, because there's so much good stuff here. You did talk about there's management that can realize what's going on and turn it around.
Yep.
And this one goes back to there were 3 companies. I don't know if we'll get to all of them, but this one was, again, very early in your career that you saw Texas Air and Continental, which I didn't know the history back there, but talk quickly about that.
Texas Air and Continental, I was in the book just because at one time Texas Air Corp was the largest airline in the United States by passengers and available seat miles. It was an idea from a very aggressive CEO named Frank Lorenzo. He passed away a year ago. And he cobbled together a bunch of airlines that oldsters remember, youngsters don't, like Eastern Airlines, People Express, Frontier, and Continental was the mothership brand. And it was the airline industry has always been through cathartic up and downs. In Texas Air's case, like so many other airlines, it ended up with too much debt and ended up going bankrupt. But I owned it when it came out of nowhere because I was visiting management in Houston over on Allen Parkway. And it kind of made sense to me that, some segment, Southwest was not going to own the discount carrier world. There would be other players. And that's what Texas did, the niche they filled. But then they like so many companies, ended up borrowing money. And borrowing money is the death of every bankruptcy out there, other than those that just run out of cash because it's a stupid idea. That was a long time ago, Stefan. I mean,
I know.
You're going back, man. You're going back.
A little bit more recent, there was Zales. You talk about Zales.
Zales was a company in Dallas. Their corporate offices were in an office park halfway to DFW from downtown. And they again brought in new management that reversed the mistaken trends of the previous management. At the end of the day, a low-end jeweler needs to be careful about lending too much money to its low-end customers. And that was one of the mistakes sales management had made. That new management turned it around, and then they got bought. They're now part of the company based in St. Louis, and I can't draw. This was about 15 years ago. So, again, management matters.
Right.
One of the things I look when I visit companies, I always ask the CEO or the CFO, where'd you come from? And yesterday, the chief financial officer at Nordstrom, quite impressive. On top of being at Target during their incredible transformation, she was at Walmart and she lived in Bentonville. I will bet on people like that.
Yeah. And so, let's skip the other one because we're running a little low on time. It was called International Gaming Tech.
Yeah.
And you had a different view of it.
And then you walk into a casino today and you still hear the Wheel of Fortune. Well,
that was them. That was them.
So that was a technological innovation in an industry not known for technological innovation.
Right. And this is going back to 1993 when gaming was just really...
Gaming was rolling out, so you had wind at your back, secular shift. Gaming was Atlantic City, but then it was starting to roll everywhere, Indian casinos. And the notion that you could walk up to a slot machine and put a nickel or a quarter in and get $10,000 because it was linked to 30 other slot machines. And their most famous slot machine was the Wheel of Fortune machine. And people went nuts for it. And the stock went from like 20 cents a share to $100 a share. It was crazy.
Yeah. And you were on that, right?
I was there. And why? Because I would physically go to their headquarters at their offices about a mile south of the Reno airport. Beautiful building. And, I met with Tom Baker. He was the CFO at the time, long gone. Yeah. And he's like, no, we're a tech company. We're not building crappy slot machines. And on top of, we want to have a product that's sexy and attractive. And there was a time not that long ago in this country where a slot floor anywhere in America would be 100% international game technology slots. Now, today, they're a distant, I think, third. So they've lost their lead. But 25 years ago, it was you go into a slot floor like the Mirage or Treasure Island when it first opened. I bet you those two casinos, when they first opened, were 100% international game technology product because they were simply better. They had a higher win per slot per day than everyone else.
Yeah. So I want to talk about when you go visit companies, and I want to ask you, has it changed? Is it hard to, even though these are smaller companies, how do you call up, again, you're a small, hedge fund manager. And again, I would say this is, rare because most people think hedge fund managers are behind a Bloomberg screen and looking at the financials of a company and then determining, okay, we're going to invest based on, EBITDA and all these other, terms. But you go and visit them. So what do you say when you're going in, and what are the visits like, and how's it changed over the past, 10 years?
Well, we own 45 stocks, 50 stocks for short, 70 to 100. First thing I tell management is, hey, we try to own stocks for 1 to 2 to 3 years. I also am very upfront. We also short stocks, but our short strategy is probably different than almost everybody you meet or read about. We're looking for stocks and companies that are probably headed to bankruptcy, and the stocks are probably $6, $7, $8 a share. I rarely short stocks that are $30, $40, $50 a share. I never short valuation, ever. Right. That's death. I also say, but we have, like today, as we look at each other, I've got about $175 million in longs and about $50 million in shorts. And I always tell the CFO, hey, we want to walk out of here in an hour knowing, you have a firm understanding of your customers, your competitors, your capital allocation targets, but also, what strategic changes might happen here. Are you going to grow, shrink? Are you going to international, focus domestic? Whatever you do, I want to get my arms around, will this management team be able to generate growing top and growing bottom line? And then what will they do with that cash? And on the long side, I'll visit 100 companies a year and only make 10 new investments in any given year. Most companies don't check all the boxes, right? They may know their customers and they may have a leg up on their competitors, but they may have a bad capital allocation strategy or, on and on and on. And on the short, so every single stock I own, I have physically been to the offices of the company, every single one. On the short side, that's not the case. Probably a third of the shorts I've been to, 2/3, I may have seen them in a conference or I've talked to them. Like I've never been to Virgin Galactic's offices. I don't think I need to go to Virgin Galactic's offices to conclude that is literally the dumbest idea I have ever seen for so many reasons. And of course, and I don't want to get morbid on you, but I'm a morbid guy, yes. But, when that little sub blew up, when it went underwater, like all it would take is one Virgin Galactic to blow up in the sky. And that stock will probably not open up the next day.
Yeah, I was thinking of that when you brought them up, right? Yeah.
So that's how I do it, and that's why I do it. And you know what? I'm the luckiest guy on earth because you know what? These are really, generally, with few notable exceptions, the people who run our public companies are pretty smart and pretty hardworking. I bet you the guy who runs Virgin Galactic really believes that's an industry. Now, he's dead wrong, but he's not a shyster. He's not a crookster. He's just wrong. And you sent me an email yesterday, and I repeated this again and again and again. There are three types of shorts. There are fads, and they're fun to talk about. We just talked about a couple of them. First Team Sports. We talked about Quokka. We talked about frauds. Well, they're the ones that get all the press. Enron, More recently, we had that Wirecard in Germany. Every year there are 2 to 3 frauds, whether it's financial fraud, it's accounting fraud, and then, of course, over here, just good old-fashioned failures. Companies that just can't make interest payments, and so they have to radically restructure, usually through the bankruptcy code, or they just run out of cash because it was never much of a business. And today, year to date, we're having a pretty good year, but that's our longs. We're up about 25 million on our longs. We're up a couple of million on our shorts. But with all these SPACs that came public in the last 2 years, and, these are companies that they're blind pools that bought operating businesses. There's a plethora, 2,000 plus new ticker symbols. And you know what? Most of them are going to end up at zero.
Yeah, because you do this very good defensive short selling in the book. And for our listeners who don't know, you say that short selling is good for the health of financial markets. So just explain why that is.
If we short a stock, if the stock starts to go down, shorts, by the way, there's no such thing as a short raid. You have to get an uptick to short a stock. So you can't just keep knocking the bid as you're selling it. But short sellers generally do financial markets a favor by trying to bring to light, both through our actions as well as when we talk to other people, though I don't talk to the press, that certain companies might be excessively valued, might be headed towards a crummier future, and that, in a way, we are hopefully making the loss if John Q. Public buys that story or that over-levered company's stock. He loses less than he otherwise might lose. I'm not a fan of a lot of my fellow short sellers who create stories that simply aren't true, that have their own podcasts or I'm not on social media.
You're not an activist short seller.
Oh, no. I've met some of them and they do really good work. I mean, Hindenburg, I don't even know who Hindenburg works for. He's in Manhattan, but he's been right like every single time in the last 3. Yeah. So these are guys who they do 3 to 10 activist campaigns a year where they short the stock, in Hindenburg's case, we think he's working for a big New York hedge fund. Nobody knows. I think people know. Of course they do, but I don't. And then he puts out like a 20-page report on the internet. He goes, I'm short this stock and here are the 37 reasons why. That's what Ackman tried to do with Herbalife, okay?
Right.
And let me make a statement. I have the utmost respect when people go that deep. And by the way, Herbalife is a horrible company that deserves to be at zero. And shame on this guy, Carl Icahn. Is he just a greedy bastard? I mean, how could anybody defend Herbalife? I'm not saying you got to be short the stock, but I bring it back because, I kind of badmouthed Mr. Ackman, who I've never met earlier. But I have tremendous respect for somebody who does a thorough short report and tries to tell the world why you don't want to own the stock. Yeah. He, by the way, Herbalife, I think, is like a $3 or $4 stock today. It's clearly finally, it's going to die deservedly. Yeah. Everything about that company is literally reprehensible. Selling a product that does nothing, doing it through multi-layer marketing with third world poor people who just want to have a better life. Shame on Herbalife, right?
Yeah, that's a trifecta right there.
Oh, it's everything bad all in one company.
Yeah. Scott, I also want to say you own it too, because you talk about your own failures. You talk about your failures in investing. You talk about 2009, and you have some self-reflection and say, you talk about holding to formulas. I don't know if we got into the companies there, but you say that, obviously we're coming out of the global financial crisis, and you probably thought that a lot of companies were going to zero because of what was happening. So you own that, but you own a restaurant, which is, again, you talk about failure, that's a high failure rate. And just talk about the first restaurant you had.
Well, it was Mudbugs. One, the name was a bad name to begin with.
Okay.
McDonald's does all this statistical, sampling and consumer focus groups. And I said, hey, I want to do a Cajun restaurant, and an affectionate name for a crawfish is a Mudbug. And of course, if I had talked to 45 people in Northern California, do you know what a Mudbug is? They go, that's disgusting. Is that a cockroach? Right. Is that a beetle? Right. Is that... So that was mistake number one. Mistake number two is you want to sell product to people something that they know and like, and trying to sell Cajun food in Northern California, specifically in a lily white community like Marin County, just didn't fit with the customers. It'd be like, you're not going to drop a vegan restaurant in some place where people. I didn't talk to my customers before the idea began. So I lost a healthy amount of money, all my own money, no outside investors. The second one has worked, but that's because it's in Berkeley. I tried it again because I like to hate myself. But that one worked for two reasons. We're in Berkeley. It's a diverse community, a lot of Black and brown people, university-related people. They'll try adventuresome ethnic food. Secondly, more important than that, is the general manager is awesome. And people matter. If there's anything through the decades I've learned, is that people really matter. And you don't know a person until you spend an hour or two with them.
Yeah, that's great advice.
You just can't read you can't read a conference call transcript and say, oh, this is a super smart CEO. You got to go there and ask them questions and see how quickly they respond and see how reflective and insightful they are. And I feel that way about everything. I feel that way about politicians. It's hard for me to have a hard opinion about somebody who I've never met.
Yeah. And what's the name of the successful restaurant that you have?
Thank you. The world doesn't need to go. It's at Shattuck Boulevard, 1 block from the University of California, Berkeley campus. It's called Angeline's Louisiana Kitchen. We're on our 18th year.
Awesome.
And we've recouped our roughly $400,000 to open, another $400,000 to expand. We've recouped that multiple times over. I'm down to a 47% ownership. I keep giving ownership to the chef and the GM because they're making it happen, and I'm never there. But it's worked. But the last 2 to 3 years, we barely made money because the restaurant industry is talk about an industry that's facing an upheaval. The restaurant industry, labor costs are spiking, and successful restaurants, I think, are going to have to pivot the service model. And part of the pivot is you're going to have to get labor out of your restaurant. And in California, labor is going to, we're already paying 18, 19, minimum wage is going up nationwide. Maybe it should, right? I mean, I've always been kind of a liberal on that issue. But that means that restaurants that are labor heavy might fail. I don't know if you saw, I don't know how much time you spent in California. A very popular fast food chain filed bankruptcy yesterday called Rubio's. The whole chain, they had over 100 fast food units in the state of California and a few in Nevada and Arizona. And they, a week ago, abruptly closed all their Northern California units and all their Sacramento units. And then yesterday they filed bankruptcy. Yeah. Oh, wow. Okay. The labor issue in America is going to be the death knell of labor-intensive restaurants. So the model's going to have to change. You're going to have QR codes instead of servers. There are a lot of things you can do to change, but to not change, to just have your head in the sand, you're going to see more bankruptcies in restaurants. And so, Angeline's Louisiana Kitchen.
Well, that's 18 years. That is amazing. That's again a rarity in the restaurant business. So congratulations on that. I also want to give a shout because, way back, I don't know if I can take credit for this one, but there was a nice article about you, an institutional investor. And, all the proceeds that for your book went to a school that you helped build called the Oak Hill School.
Well, the book lost money, and I think the book is...
So the kids got no money?
Well, no, don't worry about that. The kids
you're funding this. I'm kidding.
Because that actually is more important than anything I've talked about. So this is a school for intellectually disabled kids. The bulk of them are on the autism spectrum. Some are just my own son. Of course, it always is something that touches you. My own son is diminished intellectual. I have 3 kids, and one just, bad luck, right? Believe it or not, we're going into our 24th year. We have 55 kids. It's all called Oak Hill School in San Anselmo. All the kids are intellectually disabled to some degree or another. The school districts pay for 50 of the 50 plus 5+ kids. And I wrote that in the book. I mean, the book lost money. I had to pay my friend now, my employee, my ghostwriter.
You're telling me I didn't do my job then? We didn't sell enough books?
I never, I get a lot of grief. I never promoted the book because I'm kind of like, I'm a nobody. But, that famous Boston money manager wrote that book, Margin of Safety.
Yeah. Seth Klarman.
He never promoted it. You can't even get your hands on that book.
No. Well, that's the thing. Maybe we got to get it out of all the bookstores, and that's because it's scarcity, right? You can't find it, so now it's.
Well, he doesn't want people to read his book. That is, oh darn it, he's a legendary Boston.
Yeah, Seth Klarman.
Of course, Steinhardt wrote a book called No Bull about 25 years ago. That's a damn good book. And again, Michael Steinhardt never promoted it. He didn't care. He just wanted to write the book, I guess, for posterity's sake. And that's a must read. And then another must read is a book by my guy who was literally in my MBA class in graduate school, a guy who wrote a book called Big Money Think Small, Joel Tillinghast. He just retired. Okay. He ran the Fidelity low price stock fund. And when he showed up, it had $1 billion. And when he left, it had $70 billion or something. More than that. he's generally regarded, Joel Tillinghast, believe it or not, is generally regarded as the greatest fund manager in Fidelity's history. And they had a very famous person there for a while by the name of Peter Lynch.
Yeah, Peter Lynch, right?
And that's a good book, too. Peter Lynch's book is quite good. But there are a lot of guys who write books in the investment game, and then they just kind of like, well, okay, now I go back to my life.
Right. So I should say Scott includes books that you've read in your investment letter. So I'll include some of these on our website and put them up. But that's great. So and again, how many companies now have you visited?
Oh, we're north of 2,500. There are a lot of repeat visits in there. Let me plug a current book I'm reading by Gretchen Morgenstern. You probably looked at it, called "These Are the Plunderers."
Yeah. That
is a great book.
Yeah.
And you had Rob Copeland on. I finished his book last month, about Ray Dalio.
Yeah, great book.
That's a good book too.
Did you watch my interview with him?
I haven't. That's all I'm gonna do for the next 48 hours is watch. And the school Oak Hill. I give away 10% of what I make. The book never get the book, so you don't have to worry about Oak Hill needing donations. I'm taking care of that.
No, it's just a great thing that you do, and I appreciate you taking the time, Scott.
Thanks.
It was such a good book, and again, I think it has lessons for CEOs who are in the middle that run their business would benefit from reading it. Investors, everyone would benefit. So whether you're starting out. It's not a book about short selling, although, there's a good defense of it there. So
there's a lot in there for it. Just about don't make these same mistakes.
Right. Exactly.
Really, it's just these are mistakes that others made. Let's learn from them, right? I learn from I make a lot of mistakes. So, yeah.
And you own it. That's your time on Read the Bull. I want to thank you. It's Dead Companies Walking.
Thank you, Stefan.